Hello, everyone. My name is George Sun and the founder of Sun Endowment. Today, we're into our part two, which is class five of our company funding 101 class. So, which will go in details about financial statements, which is quite important. So, let's talk about the first thing that really matters in a company. So, which is the balance sheet. It reports the current liabilities and long-term liabilities, and also the asset and shareholder equity. So what does liabilities mean, you might ask? It means debts that you owe to a third party. An asset is basically what you have. For example, cash flow. Cash is just one example. Also, maybe some equipment you have that count as an asset. And as we can see here, this is an example of it. And on the left side, you can see the assets, the current assets, and then there are investments that there is, and some um, liabilities on the right side, which there are short-term liabilities and long-term liabilities. And because some companies want to go public and who are already public, which have the equity part, which is down here on the bottom right side, you can see the common stock and the total shareholders' equity, which is $289,000 in this case. And we're going to detail of what this means and how can we get, like, what can we tell about this company later. Now let's talk about income statement. And this is pretty straightforward. You take account of your profit expense. So you show the net profit and you report on specific sales and costs as well. So this is an example of that as well. So as we can see here, is for the 3 years, 2020, 2021, 2022. And we can see there are gross profit, interest expense, operating income, and stuff like that. And then you can see the net income at the end by doing all these calculations. So for the cash flow statement, it reports inflows and outflows. What does those means? We'll go into detail of the specific meaning in later part of this class, which is, I think, two class or one class after this. And it came from operating, investment, and financing, because that you might use money or you might gain money from those three things. And usually it gives you the comparison before and after the year to give you a general perspective of how your company did. And as we can see here, that these are the three main things: operating, investing, and financing. And this is the beginning of the year, and this is the end of the year. So cash-wise, they are 92,000 above what they had in the beginning. So I showed you all the statements. What does that mean? It can calculate the profitability, and the return on equity means net income over average total equity. The high and stable means it is the best. This means how much you're getting from your investment. So as we can go back, this is the net income. As we can see here, let's just take 2022 as an example, which is 165. And then average total equity, which is right here. So this means that this company is not that healthy because right now it's not that high and it's not quite stable. But it's just using two different full sheets, so we don't know. Like, this is probably not a real company. And there's the net profit margin, and there's the net income or sales times 100. So sales, you might use this in the manufacturing business. For example, I sold 100,000 units of cars, and net income, let's say I got 100,000. So that over that times 100, which gives you the net profit margin. From a profit margin, of course, you want as high as possible, so higher the better. And the gross profit margin means the total profit over sales. Keep in mind, this is net income and this is total profit. These two are completely different things. Total profit means this does not deduct all the expenses while net income does. And then we look at return on asset. I have explained previously of what asset means. So this means the net income over, for example, all the equipment, all the cash you have times 100. So we have to look at the liquidity of a company as well to determine if this company is good for investment. So there are two things that we have to keep in mind for liquidity: current ratio and quick ratio. Current assets over current liabilities, liquid assets over current liabilities. Now we have to introduce a key concept of what is liquidity. What do you mean by, like, you might ask, what do you mean by, like, oh, what is something that's liquid? Cash is the most liquid thing because you can just use it immediately. Something toward the lesser of a liquid end will be, for example, real estate. You can't sell that immediately, so it's less liquid than cash. So current assets means the total ones, and current assets is right here. I can actually give you an example. That's the current liability, 61,000. Total current assets, which for this one include the cash, short-term investments, accounts receivable, other receivables, inventory, supplies, and it total up to the current asset 89 over 61. So which means this is extremely healthy company because ideal is 1-to-1. This surpasses that, which is really good because it means they can pay off their liabilities and still left with some assets. And the quick ratio only took into account of the liquid assets and the current liabilities. Let's see if they have it here. Liquid assets. I don't, well, yeah. Oh, wait. Oh, no, I don't think they have it. So, but it's just taking account of cash over current liabilities, which ideal is still 1-to-1. And now we look at solvency, which involves debt to equity ratio, and debt ratio. So total liabilities that we looked at over total equity, which shows you the investment return, and the good return ratio is between 2 and 2.5. High means it's growing but immature. Low means like this is extremely mature, but it did not allocate the resource well, which means there are changes that needs to be made to the system. And the equity ratio is total equity over total asset. We all know what that means. 50% ratio is a good number. And greater, I mean, when something is greater than 50%, means it is a conservative form. When it's less than 50%, means it's a, I mean, sorry. I mean, less than 50% is a conservative form, firm, and greater than 50 means a leverage firm. Why is this? Because your assets can pay off your equity. So when your asset is extremely better, like significantly better, their equity means you are way more conservative. And you have to look at the debt ratio as well. Total liabilities over total asset. The good ratio is between 1 and 1.2 or 1.5. So as we can see here, the total liabilities is 481. And over that of, wait 1 second, over that of total asset. Total asset here is 770. So this is 770 over 481, which is more than one. It's between 1 and 1.25, which is healthy. The key financial ratio, efficiency. So inventory turnover ratio means how fast you're replacing and selling your to quantify that, sell your units to quantify that. So cost of goods sold over average inventory. So it's usually between 5 to 10. That's a really great ratio. The receivable turnovers ratio means the credits, how much money you're getting, and average accounts available. And the great ratio is greater than 7.8. So now you know how to look at a balance sheet, income statement, cash flow statement, and do all the calculations and to judge if your company is in healthy state. So believe you can be successful, and thank you so much for listening. I'll see you in the next class.